Renewable energy counterparty risk redefined in 2026. Counterparty risk has a new definition in 2026. Corporate buyers spent the better part of a decade treating their renewable energy suppliers as the stable side of a long-term agreement. That assumption has not been tested at scale until now, and the results are more complicated than most finance teams anticipated. When a large corporation signs a 10 or 15-year power purchase agreement (PPA) with a renewable energy developer, the counterparty risk conversation usually focuses on the buyer side. Can the buyer sustain the commitment? Will the credit terms hold? What happens if the corporation restructures? The supplier is treated as the stable anchor in the arrangement, a project company backed by physical assets and long-term contracted revenue. That framing has not kept pace with what has happened to the renewable energy development sector since 2022. A combination of rising interest rates, tariff disruptions, incentive rollbacks, and interconnection delays has put significant financial pressure on a sector that was already capital-intensive and margin-thin. For corporate buyers with long-term supply agreements in place, the relevant question in 2026 is no longer just whether the contract terms are favorable. It is whether the counterparty can perform. How developer financial stress has changed the risk equation for corporate buyers. The renewable energy development sector entered 2026 in a materially weaker financial position than it occupied when most large corporate PPAs were executed. Deloitte's 2026 Renewable Energy Industry Outlook documented a 41% decline in deal value and a 45% drop in transaction volume in the first 9 months of 2025 compared to 2024. Asset-level deal activity fell 89% in volume during the same period. That contraction reflects a sector under genuine financial stress, not a temporary market pause. Rising interest rates compressed project economics for developers whose business models depend on cheap debt. Construction cost inflation outpaced revenue projections in projects that broke ground after 2022. And the policy environment shifted in ways that removed or narrowed incentives that developers had incorporated into their project financing assumptions. The result is a population of developers who are managing active supply agreements while simultaneously navigating balance sheet pressure that was not part of the picture when those agreements were signed. For corporate buyers, this creates a specific kind of exposure that is different from the more familiar risk of a supplier missing a delivery milestone. A financially stressed developer may be technically performing today while accumulating conditions that make underperformance or default more likely over the remaining contract term. Most corporate finance teams are not monitoring for that risk in their energy supplier relationships the way they would in a traditional supplier credit review. What counterparty instability actually means for existing supply agreements. The practical consequences of counterparty financial stress in a renewable energy supply agreement depend significantly on the contract structure. In a physical PPA, where the developer owns and operates the generating asset, financial stress can manifest as deferred maintenance, reduced operational availability, or the developer seeking to sell the asset to a third party. Each of those outcomes has different implications for the buyer, depending on what change of control and assignment provisions the agreement contains. In a virtual PPA or financial settlement structure, the risks are different. If the developer is managing a portfolio of financial contracts and the portfolio comes under stress, the buyer may find itself dealing with a counterparty seeking to renegotiate settlement terms, invoke material adverse change provisions, or transfer obligations in ways the original agreement did not clearly anticipate. Bloomberg Nef's 2026 Corporate PPA Tracker identified counterparty credit review as one of the most underutilized risk management practices in corporate renewable energy portfolios. Fewer than 25% of large corporate buyers reported conducting formal credit reviews of their energy suppliers on a regular basis, compared to more than 70% who reported conducting regular credit reviews of their top procurement suppliers in other categories. The gap between carbon commitment and supplier viability. For companies with public climate commitments tied to specific supply agreements, supplier financial instability creates a secondary problem that sits outside the contract itself. If a developer defaults or fails to deliver contracted volumes, the corporate buyer loses the zero carbon supply attribution that was incorporated into its emissions accounting. The replacement cost is not just the price difference between the contracted rate and the spot market. It is also the cost of sourcing equivalent renewable energy certificates, potentially at materially higher prices, to maintain the emissions claims already made in public reporting. The Science Based Targets Initiative, SBTI, removed over 200 companies from its dashboard in 2024 for missing validation windows, according to SBTI's own published data. Some portion of those removals reflect organizations whose supply arrangements did not perform as expected. Companies with near-term science-based targets and supply agreements tied to financially stressed developers are carrying risk in their emissions accounting that has not been formally assessed or disclosed. What finance teams should add to their counterparty review process? The starting point is a simple categorization exercise. For each active energy supply agreement, what is the financial condition of the counterparty today relative to when the agreement was signed? That question does not require a formal credit analysis. It requires reviewing publicly available information about the developer's parent company, project financing structure, and any disclosed covenant violations, rating actions, or material changes in ownership. For agreements tied to project companies rather than operating parent entities, the review should focus on whether the project is performing within the parameters that supported the original financing. Projects that are producing below contracted output, experiencing higher than projected operating costs, or dependent on incentive streams that have been reduced by policy changes are carrying conditions that can compound over time. The goal is not to identify imminent default risk. It is to identify the agreements where the counterparty's financial trajectory has diverged from the assumptions in the original deal structure, and to do that assessment before a missed delivery or a renegotiation request surfaces the problem in a less controlled way. Finance teams that have already added energy supplier credit review to their standard counterparty monitoring process are in a better position to manage outcomes rather than react to them. Where C-suite leaders need to push for clarity. The organizational gap is usually not that finance teams lack the capability to conduct this review. It is that energy supply agreements have historically lived with sustainability or procurement teams, and the financial risk monitoring practices that finance brings to other categories of supplier relationship have not been applied to energy counterparties with the same rigor. C-suite leaders asking the right question in 2026 are asking whether their organization knows the financial condition of every counterparty in their energy supply portfolio, not just the commodity price exposure. The answer, in most organizations, is that they do not. The ones addressing that gap now are adding counterparty health monitoring to their energy risk framework before a stressed supplier surfaces the issue for them in a quarterly earnings call or a missed delivery notice. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.